All right. So let me turn off my music so I can get on. So we'll give it a few minutes so we can start. But today since we have been only training the index X SPY, and I have been doing some trades on the Qs on the side. I haven't done any Russell 2000 trades, but we are gonna look at internals instead of individual stocks. But it's gonna be a quick thing or a very basic overlook of internals, because in reality there's no 100% way to look at internals. Is you have to give it a representation in your head day by day. So it what helps you understand it better is the screen time. So if you guys do it separately on your charts and you just keep an eye on it and try to get a feel for it, internals will give you a better understanding for next time forwards. Because at the beginning it's just gonna be lines and squiggly lines, and they're not gonna make sense. So we'll see. I'll tell you guys little by little if you guys want to take a few notes so you understand what they are, and then I'm pretty sure anybody can access them through TradingView even if you're not using Thinkorswim, because I know there's a lot of Robinhood users or any other broker users. So I'm a little nervous, guys, and because my girlfriend is here listening. So you're gonna hear me ramble a little bit, but I'm gonna try to get on point. So we got the usual attendance. So Kami's here, nice. I hope Bilawa can make it here. Man, I'm gonna send him a message because he's been sending me messages, and I like that people get that get interested in learning all this stuff. So when we're watching trades, they can also take their own decisions, because remember, at the heat of the moment, sometimes you have to take your own exits or your own entries, right? We take our, I think KK, he's not here. Oh, he's here, right? Kevin, is that you? KK, has been taking his own trades, so that's pretty good. That's pretty good. Like we cannot rely only on alerts, and sometimes even if you're on an alert, based on whatever you learn, based on your knowledge, you take your own exit. You don't wait for a alert, because sometimes by the time I exit, this thing turn around, and for example, I think today we were on a BABA trade, and I was not looking to call up for an exit, because I think this was I call up for this trade, right? We joined about right here. And I told everyone where I had my line 119.96. We reach a target and I'm out, I'm out. I don't even look back. It's right there. I don't know how much money was in the trade. I don't know what the contract was at. Just hit the market order and I'm out, because I know the spread was like a couple cents. So sometimes you have to, if you ask me for a level, when I reach that level, I'm gonna be out. I'm not gonna wait for this to I'm not gonna, me, I don't shoot for the stars, I shoot for the levels that I get, So, and eventually we got a bounce, we got a deeper low though. So I'm not sure if I was right on this level, but pretty close, right? What's the difference? So, all right, we're gonna go over a little bit. I don't know if did anybody brought any of their charts today, or any specific stock that you guys want to look at. If not, then we'll just continue with the SPY. And so I'm gonna get with SPY, right? And this is how it looks when you're trading. This is how it looks. I don't know if you can see all these lines. It's messy. It's nasty. It's a battleground right here, but it helps you, and you with your own eyes, and what you placed. You know how important those lines are. If you start changing for dashes, for color coding them or whatnot, what they represent. If you're gonna give it importance or not to those. So I know at this level right here, it was important. So I was like, I don't know if we poke around it, I don't care. I think we're bearish underneath it, and we are. Even we're trading below it, so we're. Or a lot of put may work by tomorrow. I think we open around this level tomorrow. We'll see. It's just a guess. So we'll see. I don't know if you guys heard me throughout the day, but we've been talking about internals on the market. This is the SPY. This is a 500. I guess most best companies in the market. Then they try to keep the market is constructed to go up all the time. It just goes up, and that why? Because it has the best companies in the if they don't perform well, they're out of the index, and they bring a company that does perform well. You know? So it's a mechanism to only go up. That's why a lot of people invest in this thing for the long term. You know, I mean, obviously, if everything comes down, this thing is going to come down. So now everything goes up, right? So let's just look at SPY. I mean, it's just a monster rally. It's scary if you look at it on a monthly basis. You know, it's just think about it. Think about the whole way down that we have if we're gonna start at some point hitting any of the supports or resistance on the way down. A bear market will just bring it down, but I'm not here to talk about doom and gloom. You know, we're just gonna do intraday trades and whatnot. So the market itself has breadth within, right? So obviously the SPY is traded like if it was an individual stock, not like if it was an index. But the SPX, it's a cash settle, it's a index that tracks the stocks. So it's a little bit different, you know. So this is the one that matters, the SPX. If something's coming up or coming down on the S&P 500, the SPX is gonna feel it, and the SPY is gonna trade based on what the SPX is doing. Can you base your trade positions on the SPX based on on SPY based on the SPX? Yes, but the movements are so similar, so quick that I mean there's no point, like you're just trading the same thing, right? So when you look at breadth, the whole market as a structure. Oh, there's somebody on chat. I see full chats. Hold on. Oh. When you look at breadth, the whole market is a structure as if it was having its own heart, its own internals and whatnot. So this is the stuff that I look at when I switch to this. I have this on my charts, and you type the stickers on TradingView or write them down. But I have SPX. You guys all will know it. I have the tick on Thinkorswim. You can find it with the dollar symbol TICK. Don't pay attention to this. I'll tell you what it is. I got the VIX. You guys know what the VIX is, the volatility index. I got the ADD, which is the advanced decline lines on the NYSE. And you guys know what the NYSE is, the New York Stock Exchange. We have a lot of exchanges, right? But most of the stuff is either on the New York or on the NASDAQ, or what we trade, right? And the ADD, it's the advance and declines on the New York Exchange itself. So even though this thing has a lot of stocks, I mean, the NYSE, the NYSE, that's what they call it. The NYSE, it's very wide and has a ton of stocks. They also react to what the SPY is doing, or the SPY will react to what the stocks are doing. You know, so you'll find some kind of correlation. And the ADSPD, it's the advanced declinance of the same idea, but instead of the NYSE, this is inside the S&P 500. So if you look at it, it opened very bullish, but it stayed flat throughout the day. So for continuation to go up higher on the SPY, you will have to have this going up as well. And we didn't, right? The SPY stayed flat. So it's the same idea. So the stocks that are going green versus the stocks that are going red. So this thing will move up higher as more stocks are going greener, and will move lower as stocks are going redder. And the positioning of these lines are important in itself, not much of the value. I mean, the value does represent something, right? You open this much, so a lot of stuff is green, a lot of stuff is higher. But at some point, if you start crossing the zero line and whatnot, they just start going into more negative territory, that more stocks are going red, red, red. You know, for example, what happened on the session that we were green and everything started coming down. So you'll see the correlation of the stuff, you know. And I'll show you how it looks like today. That was a flat day. Yesterday, that was a trending down day. And I'll find a day where it was trending up. And yeah, you'll sometimes you'll see this coming lower first before the SPY, and then you'll see the correlation. Sometimes you'll see it coming higher before and then the SPY, but it's a give and take. Sometimes the SPY will do it first and then the stocks. So it's like you have to identify which day who's following who, or if they're remaining the static or the same, right? You just gonna have to look at this every day. You know, the screen time, a lot of screen hours. You don't get good at this overnight. You know, you just do a lot of screen time. On the bottom, I had the VVIX. You guys are hear me about this one sometimes with Alfonso. This one doesn't matter the shape or the cancels what it's doing, but just if it's going up or if it's going down and the value of it. Like you just have to. This is the volatility inside the volatility. So in other words, the VIX, meaning this is the volatility inside of the options or S&P, the whole market. And this is what you know that a lot of hedging is occurring. Like right now we're having high VIX, and the VVIX means that how are the range of the VIX the VIX is going. You know, if it's going too much high up or too much like going down fast. It's just the VVIX represents the volatility inside the volatility. It's this is not tradable like the VIX. It's just a metric that you just use to track how the volatility inside this is. You know, so a lot of people where I'll show you right here on AutoZoom right here. A lot of people were buying when the VIX spike up to this level, and we know there's a resistance right here. A lot of people were buying puts because we know that the VIX historically on this purple line has rejected many times right here. So they know that you can have a rejection out of this line. Now, you're buying puts, but at the very same time, the VPIX is high as above 140, super high, you know. So when you're buying puts and your trade is working out, you may be losing money on the VIX puts because the VVIX, it's also decreasing. So you're offsetting your delta gains when it's coming down with IV decreasing off this level. So it's very important to understand this. You know, you don't go straight up buy puts on the VIX because you don't make money when you're offsetting your delta gains with IV decrease like that. It's just not, you know. So what's the best to, a lot of people rather sell high premium contracts when the VIX is like this or the VVIX super high like this. So it's a way to trade. Obviously you have to nail the direction, right? Because let's say if you're selling puts, that this thing is still skyrocketing, you're gonna lose money on the put side, selling puts, right? If you're selling premium, because the VIX is gonna keep going up, the puts are gonna keep increasing on value and whatnot. You know, the VVIX is gonna keep increasing on value. So historically, this is pretty high. I mean, just look at the daily on the VVIX. This is pretty high. The normal is around below 110s. You know, and if you look at the weekly, the normal used to be before 2019. It used to be somewhere around 85, 70 or so. So I mean, this is pretty high. It's pretty high, but I mean, we can reach high. Look at this, somewhere in the middle of 2019. No, I'm sorry, this is 2021. This is March 2020. I'm sorry. So it can get pretty high sometimes, but it does not stay high that much. So I track this when we're looking at where this thing is going. If we're looking into a bear day, I'm looking at how this is going, you know. So the DXY right here, save it up right here. The DXY is the dollar index. So this is a good metric to follow sometimes, because the dollar is measured in a lot of with a lot of stuff. I mean, this is just like a commodity that is used for trading. You know, a lot of the stuff that it's not only a currency, it is, but it's a commodity that is used for trade. The oil is traded in dollars. Countries trading in dollars. So everything is. So this is essentially a commodity. And what this means is that when the dollar is going up, It means one of the metrics that is used to push the dollar higher is that people are selling assets to get into the dollar, you know. So when this is going up, this means that there's risk off on the market. It doesn't mean that the market is coming down, but there's risk off. You'll find either safe sectors like XLU, other places going up, as well as the dollar at the same time, you know. So it's funny because we have printed so much money and the dollar is going up, and it's just that's how strong the dollar is. Doesn't matter how much you print it, this thing is going to go up in value, and you'll see it. Yeah, people look at this to trade forex and to bet against other currencies like I'm Mexican, you guys know it, and I know the Mexican peso has been rising lately, and it goes along with the line that not the Mexican peso is rising lately, the dollar value against the Mexican peso has been rising lately. So I know it's because the Mexican peso is coming down at the same time this thing is coming up, and thus creating the difference, right? As for the markets on the equities, why it doesn't matter to us, because when we see something like this going on, when the SPY is doing this, it means that the market is really risking off right here. You don't trust a move up. We don't want to get into calls because this thing is also rallying up. You know what I mean? So this thing is going up. There's risk off of the markets. When this thing is coming down, there's risk on the markets. People better put their money on assets or on the stocks or on the stock market or anything like that, because this will what's it called? Because the dollar will be decreasing in value. So when you see a dollar coming down, there's a better or greater chance that the stocks will move higher. So we keep this in mind, right? On the side, I have the trend. This is very new for me. This is it has to do with, let me look for the essential it's called the short-term trading index, right? The let me know if you guys can hear the background. Can you guys hear the background right now? Or it's just me? You can hear? All right. So this is basically it's like if you were combining the ADD with volume. This basically is. But I don't really understand it, how it moves. I gotta put more screen time on this. I just know that at extreme values, market is very bullish, and at extreme value lows, the market is very bearish. So I just look at this whenever it's at certain values, right? So right now, let me see, trend screen. Let me remember this real quick. Okay. Okay, when the trend is around 2.5 or above, that's an extreme value on it. So it means that we might have placed a short-term bottom at the moment. When the trend is 0.5 or below, it means that it indicates that an uptrend in the market for only a short while. So we might have placed a top, a short-term top if the trend is at, look at where it closed right now. That's very important. We may have placed a top, a local top when the trend has reached 0.5 or 0 or lower, right? And you didn't see it the whole session until at the very end, right here. So that's very important, guys. Very important. So, and when you look at the trend right here at the end, did not reach the extreme values from the previous session to indicate that it was going higher. But at the moment, we do have indicated at the close that we may have placed a local top for the moment. So, so these are the stuff that I'm looking at, right? I guess I kind of went over for what ADD is, for what ADSPD is, the VIX. You guys know the VIX. The VIX, people go against doing technical analysis on this, but just the most that you can do, don't do patterns, do trend lines. and do what's it called, support and resistances. All right. That's as most as you can do, because I shorted the VIX right here. I shorted VIX calls when we were at this high before, so it worked. And just it was only based because of this trend line. You know what I mean? This trend line, this resistance right here. So it was a 2-point conjunction for me to take the trade. So those kind of work a little bit. So make sure you guys can use it. And let me know if you guys can hear the background, because I can hear it. Hold on, give me 1 second. All right, back. All right. So right here on the on technical analysis on the VIX, right? So you don't have to look for patterns or anything like that, guys. So just your normal trend lines and your normal supports, your normal resistances, and that's all you're gonna go for, right? And why do they work is because this thing is essentially an inverse of the SPY. So if you look at dips on the SPX, you look at dips on, you'll see the VIX has spiked up at the same spots. You know, look at my cursor right here. Spike up on the VIX, 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 and so on. You know, so they do matter because they might indicate the where the bottom is in, right? There was a trading day that we could have managed the bottom on SPY just by looking at this line right here, where it hit the VIX at the resistance. So there's something for you right there. And one thing to mention right here is that when you're looking at the VIX, you can find certain divergences on it, or I would say certain indications that this may push higher or lower or whatnot. You know, this is a good day. For example, right here, the VIX hit a low at the resistance right here on this daily chart, and we hit a low on SPY, and then we came lower, but the VIX did not make it higher than the last previous peak. You know, so there's already a divergence right here that it's gonna be harder for the SPY to drop lower. Eventually, it did drop lower at the end, but there's already you cannot bet that this thing is gonna keep coming down like a trend line at this point forward, because you have already placed a lower high with a lower low on the SPY right here, you know. So there's a divergence. So keep an eye on stuff like that. I keep an eye on stuff for you guys. I'm all over the place. You guys hear me in the first couple hours of the trading session. I'm all over the place when I'm full of coffee, and then on the middle of the day, I just wears off, right? The next one that's very important is going to be the tick, guys. The tick is going to be like a barcode. You guys see this? It just looks like a barcode. Essentially, it's because the tick has a range, and you'll see it. 1,000 is an extreme value to the upside, and negative 1,000 extreme value to the downside. So those are very powerful ticks, but they are extreme values, right? And a normal market will trade somewhere like this, a little bit, somewhere like this. Look at this day. You open around at that negative 1,000 ticks extreme value. It was probably a low. We were probably opening lower. Let me see. It was right here. Yeah, we were opening red. They normalize. They trade around the 0 area. Sometimes they spike up to the 700. That's very a strong buying pressure. They trade around anything past the 600 mark to the positive or to the negative. I call it the strong. So a strong buying positive at 600 plus, a strong selling at negative 600 lower. And in between is just trading, normal trading action. So you'll see a normal trading day range like this. You have to take into account how many positive ticks do we have against negative ticks and whatnot at certain points of the day to consider if we're gonna go deeper, lower or higher, you know. So at this point right here, we kind of had some strong selling at the when the SPY was dropping right here, negative 1,000 mark or so. And then right here, it recovered into the positive 500s and 700s and whatnot. Not so much strong buying at the close, but this is just a normal day, you know. There's really thick is boring on a normal day, you know. Just look at the extreme value sometimes, like, okay, we push this high with a 700 tick. I think we're gonna go higher, right? Just at this little top right here. So it does come down, it gets a retracement, but since we already have strong buying pressure, once we start pushing higher, we look for bullish entries, right? Just a normal day. But what's been happening lately is this, which is very extreme, guys, very extreme. You open with a super negative, super positive tick at this gap up right here, right? But the selling is weighing down as we're going up. The selling, the buying is slowing down, but it's still very strong. We're talking about that we're spending a good area right here about the 600 to 1,000 ticks, and then out of nowhere we start hitting below negative 600 ticks on this dip right here. So at the highs right here, we have we do have some strong buying, but as soon as we start breaking down, this is not even a strong selling at this point, but when we start seeing these values right here below a negative 800, negative 1,000, negative 1,200, negative 1,300, this is just extreme selling, guys. This is what was this when Apple me starts laughing when I start saying the slapping the ask, because this is what's happening. People are just selling into the ask. It's just a slapping the ask and just selling whatever who is available to take their shares, their contracts, or whatever. They're just slapping it. And remember, the tick is for the whole NYSE. It's not only for the SPY. But since the market is moving in conjunction right now, it's all together. That's why we only trade in SPY right now, or SPX, because the market is just doing emotional selling and emotional buying at the same time. So this is what's happening. You know, this is how you know it's very strong selling activity. And I suggest you guys keep an eye on this for your charts. And today the tick range was also very, very big, because like I said, you rarely see the negative past the negative 600 ticks or plus 600 ticks, you know. So to see it that many times throughout the day, to see it that many times throughout the day on the negative side is just very significant, very meaningful. So taking into account, it's pretty cool stuff, I would say. So the most use that I use for the ticks is whenever, let's say, we are at because today was a tick was very a large range, right? But let's say let's put, for example, this little resistance that we have right here. This little resistance, if we look at it, if we look at the tick right here, at this high, we're reaching this resistance into a 500 tick, so it's not that great, right? We're gonna have a retracement. A retracement happens about right here, and we go with 1,000 negative ticks. So that's pretty strong selling, but it did not take it that very low. So that's a telling that this is, even with the stronger sellers out there, this doesn't really go down that much. When we hit the same point on the on this right here, so you will say from here to here on the ticks, this is why difficult, right? Because the ticks were very strong. At any point of the day, you see how many strong ticks were this whole area right here from, this whole area of ticks. This is a lot of the ticks at the about plus 600. So it did push with a strong tick, so you know there's more upside coming. But like I said, today was a very strange day. The tick does not behave like this. If I go to more days, you'll see that the range it's a little smaller. The range is like from, I'm sorry, freaking lines. Oops, I chose the arrow. Let's see why.
Come on, Cubito.
I know, I know. So the range is about right here, and any spike up, it's meaningful selling, meaningful buying. But then when you look at the rest of the chart, it looks like the range was more like this, like way higher. This thing is way higher, and the spikes are just. This is just the whole trading day was probably has been the whole trading. These 2 sessions, I would say almost the 3 sessions from here. The range has been pretty wide. So, but it's still very useful tool. I don't know if Alfonso wants to do any input on the text or any other stuff that we have mentioned. You got anything, Alfonso? Now that
No,
you're here.
Actually, not just that. Just to have in consideration that the ticks belong to the New York Stock Exchange, not the
Yeah.
S&Ps. And the ticks at the open are not very.
Oh yes, yes.
They,
The
they,
value.
they don't count at all. I mean, besides
Yeah.
that, it's a good. I mean, you can create a. What you have to look, for example, is divergence on the ticks. Ticks going down, price going up. In that type of divergence is when you see that the price is gonna move. It's gonna reverse. If you
Yes.
see ticks going up and price going down, that's a divergence. And the ticks the ticks are the ones who determine where the price is going, not the price itself.
And he's very much right about that. This is just of the New York Exchange that it's been very helpful lately because the market is moving and all together. But on a normal trading day, you'll find it quite difficult to use the tick to the S&P because obviously it's not all the stocks that are on the SPY. And there's a way to measure the tick on the SPY, right? I just don't use it that much. I think it's on. No, I don't have it. Is it this one? I think. Let me see. Yes. So this we have an indicator right here that I don't know how to use it, and since we're not on a live trading session, yeah, it'll show me right here the ticks, but I need to learn how to use this because I haven't paid attention that much to it. But one of the lines is the ticks for the Nasdaq, one for the NYZ, one for the S&P 500, right? So, but I'll try to learn how to use it a little bit. I just don't know how to use it very well. And yes, the very first values of the ticks are not to be paid attention of since the market session is just starting and there's a lot of activity going on. So, and on the very right corner right here, this is not much that important, but if you see this is the SPY, and this is a SPY right here, no levels right here, and this white line represents the ADD line. So basically this with its percentage move adjusted to the percentage moves of the SPY. So it's just for me a way to track if the market on the NYC, obviously we know that it's moving in all together with the SPY, which is basically kind of did, I mean, a little bit. There was I guess right here the market was going away of itself from the S&P 500 components, and it went a little higher than the rest, right? But you see a correlation. I mean, you see that this thing is almost the same. So I keep this on watch. I really don't use it that much. It's just in case. So some of the days there'll be a huge divergence, and then the market decides to move together. Either the stocks or S&P are gonna follow each other. So there's that. Let's say let me try to see if I can go over let's see if I can go over today's trade. I think that we only had one bullet for Alphonsus Francis, and that was good because we would have traded another thing when we were all flat, and so that helped us. But there was a moment where we noticed when it was right here, right? I think I want to remember why we took this trade. We knew there was an overhead resistance. It was right here, Alfonso. I don't remember. let me see, let me think about it, because we took a put. Came down lower, yes. I think it was just at the start right here. There was, we noticed there was a resistance up to this point. And let me extend to the left. Okay, yes, I cannot remember. We took the trade. Where did we take this trade? I don't remember, guys. I don't remember, but essentially we look at the levels and do analysis on market internals to decide on the trade. Because I don't remember if we took it off of this high or off of this high or off of this high. Either or we took somewhere off of one of those highs, we took a put. And it worked, right? I messed up on the selling order, but it worked. So for the next trading sessions, I know the SPY is looking bearish right now on futures. If you notice at the after hours session is coming down, and you guys know I took some puts and whatnot, and I'll explain you the reasoning, because to me, I don't know if you guys know that I used a lot of the FIBO retracements for entries and whatnot. I do think we're gonna keep coming lower on this, on the daily, but not everything's gonna come straight down. It's just as not everything goes straight up, not everything goes like straight up. You're gonna have your red days and your pullbacks from here and there, right? Nothing's gonna come down straight down. So how do we know if we're still under on a bearish trend and haven't turned around? We just look at some of the big indications that this is working, right? I mean, this is still in a downtrend. We haven't broke the downtrend at all, even though at green day will get people euphoric trying to buy the dip and eventually get burned if we start coming lower on the next days. So I don't know if my put's gonna work overnight, can turn around, whatever, you know. But I take you know how I use the FIBO retracements when we have a move to from a high a local top that we had, and oh, thank you. Sorry guys. So we printed a little local top right here. From we went down right here. We had a push to the upside right here. So I take this as a temporary top, and I drew my FIBO retracements right here to the bottoms of the move. Right here. Spot. Did we poked a little higher actually when I took those puts? We were at that very much level at the 50. You see it's drawn out on this chart right here. That's where I took it. So if the market decides to just do a bounce and it starts doing the retracement to keep the next leg down, either the 50, the 38, or the 618 is going to be the place of return. Where do you get the most risk reward? At the very top one. Where do you get the most probability? At the 50. Where do you get the most strength? At the 38 too. That's why it goes, you know, if this doesn't go up more than this and it starts retracing, the next move side to the downside is gonna be way stronger. If it goes to the 50, it's just a normal retracement. And if it goes to the 618, there's still possibility, it's just not as strong, right? But the best risk reward ratio at the 618 is because if you join a trade right here to the downside for shorts, if you're trading above it, you start closing candles above it, you're wrong. You know, you have to get out so your risk is less and your reward is potentially higher. But if you join right here or right here and it goes up to here, you should probably still hold because it's still part of the retracement. So there's no need to cut, right? It's what we call whenever people are getting panicky and it's just making a bear flag. It's just making a bull flag. It's just because the retracements are still on. So I took those puts to see if it works. And obviously, if we keep getting bad news or the market's spooked or whatever, that's going to be great news for the puts. And I took some Microsoft because I love this chart. I love this chart. You guys know that I take long swings when we're closing up of the 20. but I'm taking a short because we're closing under the 20 into what we call a potential head and shoulders, a shoulder, head, and a potential move to the downside up to this level. So we might see this work tomorrow. We'll see. I'll take a victory lap if it does. And I don't have that many plays besides this. There's a ton of stuff on the market, so, but I don't have any plays like this when the market is, it's on news driven to the downside, you know. So those are the stuff that I'll take. And on the side, I don't know if you guys noticed on the quick chart right here, I have TNX. That's a 10-year yield. For the people that want to follow this will help you understand if financials are on the move or if the bonds are getting bid up. So sometimes I don't have to look at the bonds at TLT or anything like that. So just to know where they're moving, because the 10-year yield is inverse to the bonds. And why does it help us? It's just like the dollar index. When this thing is going up, it means that the market is taking risk off. It's going into a safer asset. It's going into a safe place. So can you trust a move to the upside when this thing is going up like this? No. I mean, the SPY, look at it, the SPY right here. How can you bet that the SPY is going to move higher if this thing is rallying up? You know, people are buying bonds instead of stocks. So keep in mind the either TLT or the TNX or both, you know, watch them both. They're gonna act inversely because the higher the bonds goes, the lower the interest is gonna. No, it's more like the lower the bonds go, the high interest they have to pay to equalize the bonds investment. I don't know if I'm explaining myself, but and once you see a 10-year yield rising, it poses a threat again because it represents inflation and whatnot. You know, so I keep an eye on that, and obviously I keep an eye on Bitcoin because you guys know I'm loaded on Bitcoin. I keep an eye on crude oil because it represents the moves. It has a lot of weight on the energy sector, so I keep an eye on crude oil futures just in case. And that's I guess that's all I got. And I don't know if it was too fast. If anybody has questions or if anybody wants me to go through something. Let's see, Jet asked me, will it be beneficial to look at the ticks on the 1 minute? No. Good question, Jet. Good question. Do not look at this on the 1 minute because look at the noise. It actually recommended to be looking at this on a 15-minute chart. I look at the 5 minute just because, but you don't need to be looking at no less than 5 minutes. 15 minutes is best because it's too much noise to have it on the 1 minute. It's just too much noise. Just look at it right now. 1 minute is just moving up and down so much, right? I don't know if you guys know, but you can even go on a tick. 1300 ticks. I can go lower. Give me 25 ticks per candle. So, you know, it can even be lower, but obviously when we use that, I use 5 minutes or 15 minutes. And I just use whatever I feel like. Sometimes if the trading day, I don't want that much action, whenever I go to a 15-minute, and then I'll align this with the 15-minute. The rest I don't really care that much. But the ticks and the SPY and the VIX, I align it to the same time frame. For now, we'll keep it at the 5 minute. Does anybody have another question besides Jet? No, the stats.
I do have one, but it's not related to the charts you just explained.
Go ahead, that's fine. We're in time for Q&A.
Cool, awesome. You gave the alert for the Microsoft, the LOTTO, that
Yes.
expires today. What happens if the contract's still open, it's expiring today?
They expire tomorrow.
Oh, they expire tomorrow, so even though we got it
yeah.
for the third. Oh yeah, they do. God, my
Yeah.
apologies.
No problem. The only all of the stocks will have it expiring on monthly on the third Friday of the month, and the most liquid ones will have every Friday expiry. and S&Ps and the indexes will have expiring Monday, Wednesday, and Friday, and sometimes it'll add at the end of the month. Like we had the end of the month on Tuesday. That's why we had 0-day Ts. But yeah, contracts for Microsoft are expiring until tomorrow. And if Microsoft, I'll tell you guys right now, if it's only $15 that we're risking. If Microsoft opens here, which is lower, the contract will still be very, very way down. It's not gonna gain any value. If Microsoft opens around this support level that I have right here, or a little lower, the contract's gonna be either double or we'll see, right? So,
Thanks.
does that answer your question?
Yep, it does. Thank you.
And it is a lotto because by any chance if the market shits a bit on the night trading session, just by looking at me at the chart on the daily right here, it tells me this is gonna come down fast and hard, you know, and that's it. That's all I got, you know. RSI is about to flip. It's just primed to come down if the market is to shit the bed overnight. All right, I see Q asking when you guys trade SPY, SPX, what chart timeframes do you guys mainly use for day trading? 1 minute, 5 minutes, 15 minutes, etc. Well, if you notice right here on my charts, I do have more screens and I have more charts, but let me tell you what essentially you need. You need to have at least gone through the daily and draw levels, like any stock, you know, it doesn't have to be SPY or SPX, any stock. So I keep one right here on the daily and the other one on top on the, never the 1 minute, guys, never the 1 minute. For no reason you should be using 1 minute. It's only gonna create you panic for every time you see a red candle to sell, right? I use the 5 minutes to start the day because I just want candle structure from the beginning of the day trade. But as with day trade forwards, like we have an hour of trading session already in, I'm already switching to 15-minute candles. Alfonso uses 10 minutes. And it just goes, it has to go along with the moving average that you desire to use, you know, what's best for you to use, you know, but you have to be open to be surfing into the time frame. Sometimes a good friend told me if you're worried about a trade, go a higher time frame until it looks good. That's it. So that'll keep you on the trade, right? So sometimes you have to look at I go to the daily and start drawing levels. So if you see this very good support, and actually I'm gonna color code it because this is an important level. So purple right here. There's another good level right here. So I'll go to a daily, actually go to the weekly, get my weekly levels, what's important on the chart on the weekly time frame, go to my daily levels, go what's important on my daily levels to see what's there's a lot of conjunction for the price, and also where the and then I go sometimes to the hourly 1 hour charts, because you'll see some either trend lines or whatnot. You know, let's use SPY for example. We'll remove this. So we'll use the hourly chart. That'll give us trend lines and whatnot, you know, stuff like that we don't see on other time frames, and that might help us out later on. You know, we'll see. This is a cool one, right? The 4 hour. This is something that the video that I linked it on chat talks about this moving average. That the 4 hour moving average has been the rejection on the way down right here. The 20, this white line right here, has been the rejection of the 4 hour candles. So it's to keep in mind of, it's also you can represent it as a trend line or whatnot, and you won't see this stuff if you're trading 1 minute charts. So we use whatever indicator you use too. Like I use RSI only. whatever you use, the bigger the time frame, the more meaningful the indicator is. So if you're trying to use RSI in 1 minute, good luck, because you're gonna get a lot of oversolds, a lot of overboughts, a lot of fake signals. Any other question?
Yeah, today during the training sessions, I think it was a Cube who mentioned this, something about the combo gamma lines. What are those exactly?
Okay, so let me go over right here. I don't use them that much. That's how Alfonso uses that much, but we'll go right here. When you guys go to Discord right here and go to the Alfonso VIP where we post the alerts, in the mornings you'll find the spot gamma levels. So what this means, there's someone that I know, right, very well know, and I don't know if Alfonso is here to answer some of that question, but you'll see some of the stuff is very obvious. The call wall means that there's a ton of calls sitting on this level on ES or on SPX. It's about the same. It's the same level. It's just representing what will be on SPX or on the futures, right? So a lot of calls are sitting on this level. Market has a tough time going through a call wall because the market makers will have to pay those options in whenever it reaches to those calls. You know, they'll have to pay a lot of people, and they don't want to do that. So they want to keep keep it below the call wall or whatnot. As well for the put wall, they don't want to keep it underneath the put wall because there's a lot of people that they will have to pay those that were sitting with puts at that level. So where you see the large gamma levels right here is where a lot of option contracts for both puts and calls are presented on the chart. Where the zero gamma level is basically and a place where there's no need for hedging into the market for market makers. And a volatility trigger means that it's a special level where the market makers have to hedge along with the movement of the S&P or the futures. Meaning that if there's a drop and the drop crosses the volatility trigger on a strong move down, the drop can accelerate even further and quick because now they're selling futures against so they can hedge against the move. So that's what they mean. And what you do with these levels is that you go back to your charts and place them on your, just like on this picture, you place them right here every morning. And those may offer points of resistances and supports throughout the trading session. And those are not strictly what the levels you're gonna go for. Meaning that you're gonna place your normal resistances and supports on the charts, but also you are going to use those levels plus FIBO levels and moving averages. And once you have a conjunction of a lot of levels at the same place, you have a high probability trade. You know what I mean? So why do I take puts at a certain level? Because there's a high probability that this is going to be a wall, you know? So we don't know, we don't have a crystal ball to know that this thing is going to come down. We don't have a crystal ball and it's going to come up. We just know that there's a high probability trade at that placing point, and we take the risk reward on it. Do you have anything to say about this, Alfonso? I don't think he's here. Does that answer your question?
It does, yeah. I just gotta do more research on it to understand it better, but thanks.
Yeah, you can do let's see, just go to this website and you'll find information about it it's on chat, on the Zoom chat right there.
Awesome, thanks, man.
This is a little more advanced stuff, guys, but we use it as reference points. It's very good. It's very good. Any other question? don't be shy. This is the time. We still got a few more minutes. And if that's it, I just want to say that I'm happy how the challenge is working, even though we couldn't make 25K yesterday. If we had never sold. But just think of it like this today. If you hadn't sold the contract that we bought today, we would have been left with $500 back at 500, right? So if I wouldn't know that we're gonna drop that fast on the hard, obviously I don't sell, but I misjudged the ticks yesterday. I should have paid more attention that we had a negative 1300 tick, but I mean, there was something new for me as well. I mean, that it was so emotional for the market. The market was very emotional. That's what it was. Emotional selling. That's what they call it. There's different types of push downs, right? Liquidation breaks and emotional selling, and a normal trading to the downside. You know, a normal meltdown. So yesterday was emotional selling. A lot of stop orders getting hit and blah blah blah. And the challenge is performing very well, but tomorrow for people are trading it, you have to be fast and nimble with the trades, right? Remember that we used our dome right here for people that are using Thinkorswim to enter and exit the trades here fast with auto send, right? So this tool is very cool, and if now you're not using this, hopefully you have good execution on your brokers, because no way you can do it on Robinhood. Good luck if you're doing it on Robinhood, even though you cannot really do SPX on Robinhood. But yeah, that's it. We're gonna keep hard work. It's my baby, this challenge. So we can reach 10K. I mean, at 10K, we can take more risk and bring this to the more money that we gather, the faster we can build it even higher. Question for Alfonso, if he's here, can we get a little explanation on choosing contracts and date for futures? I opened the option chain, looks very different. I don't think he's here, but I can answer that for you, Jet. So when you open the option chain, let's look at boring trade today. Right, I don't know if you were here or the Baba trade. If you guys are familiar with delta and gamma on options, delta is the value that your contract is gonna gain per dollar move, and your gamma is the speed of that you're gonna get that delta higher. You know, so every dollar move is gonna add the gamma that it had on the delta that it had right now. So essentially oh, you were asking for futures. Well, for option chains, like I said, just because I'm already at this, the most profit that you can make if it's your 1 or 2 strikes out of the money, because your delta and gamma is greater at that point. You get the most amount of gains by then. When you're deeper in the money, that's why he rolls, because you're not getting that much gains percentage as compared to the lower strikes, and you will be booking profits if you're rolling. So on futures, I do not trade futures. Well, I don't know. I don't know how he takes the strikes. And this is just so you know, the futures are times 50, not times 100. When you want to know how much they're gonna cost. And yeah, I don't know how he trades futures. You lose less if you're in the money. Yes, if you are on option contracts on any other stock, if you are way out of the money, they're gonna lose value very quick, and to regain that value is gonna be very hard. Plus, if you're at close to being in the money or at the money, you lose on a less, not that fast. So does that answer your question? Because we can ask him later tomorrow when he's available. He's probably watching the Cowboys.
I'm available. What was the question? Halftime.
Oh, I was just trying to understand like the S&P futures, like the options chain because it looks different from like the regular option chain for myself.
Is what it changes is the I mean the expirations are different because are accordingly to the different future contracts. But the only difference here is that the value that you see there is the real value is half. For example, there it says it's $20.75. You're gonna pay only half of that.
So
Why
you
is
see
the
one right here.
why
you'll
is done
see it
that?
right here.
It's half.
Oh.
That's the way that they just so everything
Times
is
50.
You'll see. Yeah, times 50 instead of a times 100.
so for some reason it's half the value of what it says there. So what that is in the case on the S&Ps, in the NQs is 1/4, and every contract changes. But in the case of the S&Ps, the only difference that you're gonna see is that you just have to calculate half of it. You're not gonna pay 21 in that case. You're gonna pay 10 and a half.
1,000 sounds right.
Yeah. And those contract, even though you can trade over after market, if the expiration is today, you only have until the bell closes. All the expirations closes with the bell. If you still have futures for further expiration, you can continue trading after the bell closes.
And they're not cash settle like the SPX, so they'll assign you.
Yeah, and you have to say because they assign you in this case an E-mini, right?
Does that answer your question?
Yeah. Thank you.
But I guess anything that you want to add so we can end, Alfonso?
No, actually. I don't know if there's other questions that I missed, but
They were asking about the gamma levels, and I just told them what they are, and they can go to the website to read more about it. And they essentially are levels that we watch for more support resistances. And
yeah, I mean gamma levels are those levels are where the most of the options for the S&P and the SPX are located, the most open interest. So usually when you have the most open interest in those strikes, you have support and resistance levels because you have gamma there exposing, no? So the only difference of the gamma levels is just the different names that they use it. The gamma, strong gamma levels are only SPX. The combos are the combination of S&P, SPICE and SPX. And they are numbered by 1, 2, 3, 4, 5. The 1 is the strongest level, right? So the number 1 is the one that has more open interest in that level. So, and that's all. I mean, and I don't really analyze further about the gamma levels. I just copy them every day that they publish it. And those are very good support and resistance. Of course, each one has different meaning in terms of importance because of the amount of open interest that is in it. And also there's another 2 or 3 different ones that they call the volatility trigger, that which I suggest you to go to Spot Gamma and study a little bit about it. But volatility trigger is when gamma it changes from positive to negative, and positive gamma, when we're about the volatility trigger, is positive gamma. That means that the range is going to be less because there's less volatility. When you have negative gamma, that means that it's going to expand. It doesn't mean direction. It just said below the volatility trigger, you have negative gamma, so you're going to have more volatility. So the prices are going to move in a wider range.
yes, and we'll see those. Like I told them, we use those lines in conjunction with other support resistances and other indicators.
Yeah.
So, but I'm glad you guys want to learn. We'll keep at it. Tomorrow is gonna be another 0DT day. It's gonna be a good day. I think it's gonna be volatile. We'll see. Alfonso's already loaded on future contracts to the downside. Pretty sure.
Yeah. Yes.
You know him. You know him.
Just enjoy the ride.
But I'm glad we had good attendance today, guys.
Yeah, we have very good. Who is Ultra Alba?
That's my girlfriend.
Ah, okay.
Say hi to my girlfriend, guys.
Hello, girlfriend. How are you? That's good. Okay. At least she can be a little bit more proud now of Cubito. Okay. Okay, guys. So see you tomorrow then. I don't know if you have anything else to add. I let you close, Cube, and hopefully
No.
we can keep enjoying the ride the rest